This Week in the Boardroom, brought to you by corporate board member and host NYSE Euronext, along with governance knowledge partner Paul Weiss and contributing partners National Investor Relations Institute and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter with Corporate Board Member, and it's my pleasure to welcome my guest, Stephen Brown, who's the Director of Corporate Governance and Associate General Counsel for TIAA-CREF. And Stephen, welcome.
Thank you. Glad to be here.
And you and I are going to talk about the institutional investors' expectation of boards, which is obviously a very key topic these days, particularly when you look at things now that are instituted like, say, this say-on-pay vote, the advisory say-on-pay vote, and the fact that sometimes votes are withheld on directors. So it's becoming certainly a more important issue. But I think the first thing we ought to do is sort of educate the audience exactly what TIAA-CREF is, because you guys are no small player in this, and I think for you to understand what we're going to talk about, you need to understand your organization.
Sure, and sometimes that acronym is a mystery, so let me debunk that. Teachers Insurance Annuity Association of America - College Retirement Equities Fund. So it may be a mystery what that acronym is, but it's not a mystery what we do, because we've been around for about 90 years serving those in academia, medical, cultural research, government field, and helping them get to and through retirement. So full service financial services firm, from mutual funds to 529 college plans to life insurance to retirement plans, you name it.
And this isn't, you're managing, the big piece of this is managing the pension part of the program?
Absolutely. And we are now about $440 billion of combined assets under management. So you're absolutely right that we have a big chunk of that market serving those individuals.
So you are in the position to influence what is happening, and that's why I wanted to have you on the show, so that we could talk about that. And let's first talk about sort of the level of activism that TIAA-CREF, historically, from my perspective, you guys really haven't been what I'll call that pushy. At the same time, it appears to me that lately you've been making sure, though, at least that your message is clear.
And I think you're on target with that perspective, given the context of where we are. Standing up for long-term shareholder rights and corporate governance has always been part of our DNA for at least the last 30 years with TIAA-CREF. And in that, we've been consistent throughout the last 30 years, even with the advent of the financial crisis a couple of years ago. But I think other shareholders, small and large, have started to say exactly what we've been saying for 30 years. And so you've seen shareholders, small and large, start to stand up and ask questions about what boards should be doing. And we believe we've been consistent throughout the last 30 years. As a matter of fact, when we revised our policy statement on corporate governance last year, and after a few years of having it be static, and we made some changes, but there were no large-scale changes, because we felt what we were saying in 1985 was true in 2011. And we're of course not happy about the financial crisis, but if there's any upside, it's that other institutional investors and individual retail investors are starting to ask the same questions which we have asked for a long time.
Well, you guys we've been familiar with TIAA-CREF for a long time. You can't work in the shareholder space and the governance space without being familiar. But for our audience, explain, at the end of the day, what are the key messages that you want to communicate to the boards of public companies? Sure.
And I should say, so going back to your last question, which is, we do what we do, what we call under quiet diplomacy. So there are many times which you won't see us in the papers, because we keep what we do under quiet diplomacy, talking directly with the boards in which we deal with. Now, that said, my key message to boards, particularly now, post Dodd-Frank, with all the additional powers and rights which shareholders have been granted, is to take a deep breath. This is still an important job, being a board of director. It's a revered job, and I think you and I have talked in the past about evidence that not too many directors have left their positions. And although there are new shareholder rights, it's still a domain and the expectation, at least from us, that the boards do the supervision of management. And we don't want to take your board seat. That's not our intention. But we do feel it's our duty to the participants who we serve, and we serve over 3.7 million people in the fields of academia and medical and the other fields which I mentioned. We believe it's our duty to ensure that directors are working on our behalf. So the first thing I want to say is take a deep breath. I don't think the job has become a little bit more involved for directors, but it's still your domain to supervise the company. And I would say focus on strategy as well as compliance. Often I hear directors talk about their job has become extremely heavy with regulation, focusing on the audit committee, focusing on compliance, and that is certainly part of the job. But focusing on strategy, you can't leave that part. So as we collectively take a deep breath, we have to remember to focus on strategy. And the last thing I'll say, which is key, is your job has certainly changed in terms of communication. Shareholders want to hear from the board. And you mentioned say on pay, and that's something that Dodd-Frank brought us this year or last year. No longer is that proxy the domain of the lawyers. And no offense against lawyers, I'm a lawyer myself. But it's one of the chief communication tools that a company, albeit the board, needs to communicate with directors. And we're going to hold people accountable. We actually read those proxies. We read the compensation discussion and analysis section. That's our window into the philosophy of the board. And so being able to communicate that clearly, being able to post votes, talk to shareholders, I think is a very key factor going forward for boards.
Well, there's no question that one of the key issues in 2012 is going to be communication with the shareholders. You know, it used to be something years ago that you did around annual meeting time and whatever. Well, you know, it's, certainly on this show we've talked about it being a year-round job and being very important. Question for you, Stephen. How far does your organization push? For example, if you're really unhappy, I assume, again, you would like to go in and talk to that board of directors. But if you aren't satisfied with that, will that result in a withhold vote if you feel that somebody just doesn't get it?
Well, our philosophy is that a withhold vote against a director is a very serious action. So we don't take it lightly, which is, by the way, one of the chief reasons we appreciate say on pay, the advisory vote on say on pay, because it's an intermediate step before you get to withhold against a person on a comp committee or the entire comp committee or the entire board. So voting against a director for us is the nuclear option. We're fortunate enough, given our size at $400+ billion in assets, and our past practice in practicing diplomacy when we have these discussions, is that companies will talk to us. So I'm happy to say that when we call a particular company, they pick up the phone and they have a conversation. And through that conversation, we're able to get change. There are times which we have to agree to disagree. And if we believe that there's complete radio silence there, and that there is no movement, then we're going to use the tools that we have, from filing a shareholder proposal to running a withhold campaign to looking at whether we're going to hold the stock long term, to perhaps suggesting certain changes in the public arena. So going outside quiet diplomacy and going above board about what we think needs to change inside that boardroom.
I think the important thing that you said, though, that I would want our listeners to hear is that you take that very seriously.
Absolutely.
I think that's sometimes the frustration with other organizations, that there are errors or there are things where there's not communication and it seems frivolous almost.
Absolutely.
And I think that being said is probably a very important comment about what separates sometimes TIAA-CREF from some other quote, activists. But let me ask you this. We're going, after some spirited years, okay, and certainly the financial crisis opened the door for shareholders to gain more access because everybody in the country from Congress down was frustrated, and subsequently it made it grease the skids, if you will, for some stuff to be passed. But when you look at 2012, what are the things that, from your perspective, you think will impact boards of directors?
Sure. Well, executive compensation perhaps is never going to go away as one of the key issues shareholders and those on Main Street think about. And so, and by the way, we think that's a long-term process for a board to really think deeply about their plans. And that's, sure.
And before you leave that, wasn't it sort of in a way a pleasant surprise though this year, in the sense that when you look at those that either completely failed or that really got, even those that passed but had a big percentage, that a lot of the people you talk to got it, that I have to, if I don't get at least 75%, I better take a look at my plan though. So isn't there, at least there's some encouragement about what happened relative to that? Absolutely.
I think before we had this this vote this year, there was a lot of angst. By the way, that angst was on both sides, because shareholders had the volume of votes that we had to now cast, and the volume of paper and the proxies that we had to read grew exponentially. But we all got through it, and that's the message, and that only a very small percentage actually failed. And I think that's because on this issue, many companies get it right. And also shareholders were giving the benefit of the doubt. And coming up in 2012, the cautionary tale is shareholders are getting better at evaluating compensation. So you may see that number of people fail tick up. And that's just because as we go up the learning curve collectively as shareholders, that we are going to get better in doing that evaluation, and we'll find some spots which we may have missed. But overall, we think most companies do a decent job on this. Many companies sort of fail in really explaining their philosophy. And that's really where the focus should be, is to tell your story through that document to shareholders. And you should think about TIAA-CREF when you're writing it, because we read it. We read it. And so brevity is very important to us. Clarity is extremely important to us. We also know, quite frankly, and I'm a former disclosure lawyer, that you're not only writing for us, you're writing for the SEC, and we understand that. There's sometimes the format that the SEC wants. It's not exactly the way that you want to tell the story. Do both. And that would be my key message there on exec comp.
Well, Stephen, that we've used up our time, and I have a ton of questions that I'd like to keep asking, so we're going to have you back again.
Sure.
And by managing $400 billion, I think you deserve at least some time to be heard from that perspective. So thank you for taking the time of joining
the opportunity.
us. Before I leave you, I just want to remind you of a couple things. First of all, we have our West Coast Peer Exchange on February 29th and March 1st. It's our Peer Exchange and our Summit. And the Summit, we've held the Peer Exchange for several years now, but the Summit is a new piece, and it mimics our rather successful large event that's in New York, typically in October. So we hope those of you in the West Coast can take advantage of that. Also, on April 3rd and 4th, we have our traditional back-to-back conferences, with April 3rd being risk oversight, and then April 4th being compensation on making sure that you're improving shareholder value. So both of those are April 3rd and 4th in New York at the New York Stock Exchange. Hopefully you can take this information back to your committees, and we'll look forward to seeing you at those events. So again, I want to thank Stephen for joining us, and thank everyone for their support on Week to Week. We'll look forward to seeing you next week, where we'll make sure that we cover a critical topic that'll help you be a better director and a better committee member. We'll see you then.
Join us again next week for This Week in the Boardroom, brought to you by corporate board member and host NYSE Euronext, along with governance knowledge partner Paul Weiss and contributing partners National Investor Relations Institute and the Society of Corporate Secretaries and Governance Professionals.